Stop what you're doing right now, because what I'm about to lay out could change how you see silver, markets, and the quiet power game that's unfolding behind the headlines. While most people are winding down on a Sunday night, scrolling, eating, getting ready for school or work, there are signs that two major players, Russia and China, are positioning in ways that could shake the silver world far more than most people realize. And the reason this matters is simple. Silver isn't just another metal, and it isn't just a shiny coin asset people collect. Silver sits in a weird, powerful middle zone where it's both a monetary metal and an industrial metal, which means it can get pulled in two directions at once, financial demand and real-world usage. And when those pressures line up at the same time, things can move fast. Let me be clear up front. This is educational, not financial advice, not a promise, not a command to buy or sell anything. The point is to give you a framework so you're not surprised when the world shifts and everyone acts like it came out of nowhere. Because that's what happens with commodity shocks. People ignore the signals, then act shocked when the price explodes. Supplies vanish, premiums spike, or the paper market behaves differently than the physical market. Now, here's the big picture. For decades, the global system has run on trust in the dollar-based order. And whether you love that system or hate it, it created a predictable center of gravity for trade, pricing, and settlement. But global systems don't collapse in one dramatic day. They weaken gradually as new alliances, new trade corridors, and new settlement options get built. Russia and China have both been pushing, openly and quietly, toward a world where the West has less control over the rules. And one of the fastest ways to shift power is through commodities, because commodities are real. You can't print silver. You can't fix a supply shortage with a speech. And you can't talk your way out of physics and geology. Silver has to be mined, refined, transported, and delivered. And the moment a lot of people need it at once, the chain tightens. That's why this conversation matters, because silver is already pulled tight in multiple ways. It's used in electronics, medical applications, chemical processes, and especially in solar panels and high-efficiency electrical contacts. And at the same time, it's still viewed globally as money, an alternative store of value that people run toward when they don't trust governments, currencies, or financial stability. So what happens if industrial demand keeps rising while monetary demand returns aggressively? And what happens if big countries start treating silver not just as a commodity, but as part of strategic leverage? That's where Russia and China come in. Russia, for its part, has learned something over the last several years. When you are restricted from parts of the Western financial system, you either accept the rules or you build alternatives. Russia has pushed for trade in non-dollar channels, strengthened commodity-based partnerships, and leaned harder into the idea that real resources can be used as bargaining chips when conventional finance is weaponized against you. Even if silver isn't the biggest export story compared to energy, the logic of resource leverage still applies. Tighten access here, redirect flow there. Build deals that bypass the old pipes, and you can create pressure in places you want pressure. Meanwhile, China plays a longer game. China doesn't just think about next quarter. China thinks in multi-year cycles, building supply influence, processing capacity, and strategic stockpiles for materials that matter. If you want to dominate advanced manufacturing, electronics, energy infrastructure, and the technologies of the next era, you don't gamble on spot markets. You secure supply, you build refining power, you make sure your industry doesn't get choked when others do. Now imagine the silver market as two markets living on top of each other, a massive paper layer where contracts and promises trade in huge volumes, and a physical layer where real metal has to be delivered to someone who needs it. Most of the time, people treat those layers like they're the same thing, but they're not. Paper can expand quickly. Physical cannot. When stress hits, the gap between price and availability becomes the real story. In other words, the number on the screen is one thing, whether you can actually source metal at that number is another. And this is why silver is uniquely sensitive. It's not just hoarded, it gets used up. A lot of silver goes into products that don't come back as easy recycled supply, or it comes back slowly and expensively. So while gold tends to sit around in vaults, silver often disappears into the economy in tiny amounts across billions of devices and components. That makes supply dynamics more fragile than people assume. Now add the reality that new mining supply isn't simple. Silver is often mined as a byproduct of other metals, which means silver supply doesn't always respond quickly, even if silver prices rise, because the primary mining decision might be based on copper, lead, zinc, or gold economics. So if the world suddenly wants more silver, the industry can't just snap its fingers and double production next month. That's the setup. Now here's where the Sunday night alert energy comes from. If Russia and China, directly or indirectly, increase silver accumulation, redirect flows, or encourage settlement structures that increase physical demand, you can create a situation where the market feels fine until it suddenly isn't. This is how commodity shocks usually happen. They don't announce themselves politely. You get subtle signals first: rising premiums, delivery stress, big unexplained buying, refinery bottlenecks, shipping delays, policy headlines about strategic materials, new trade partnerships, increased domestic demand for industrial build-outs. Then one day, everyone notices at once, and the scramble begins. And the scramble is what moves price violently because fear changes behavior. Manufacturers don't like uncertainty. They can deal with a higher input cost if supply is reliable, but they cannot deal with not knowing whether they'll have enough metal to fulfill contracts. So they start ordering early, ordering extra, bidding up supply, signing long-term deals, and that defensive behavior turns tightness into a squeeze. At the same time, investors and savers watching currency risk and inflation narratives can pile in, and because silver is smaller and more volatile than gold, the percentage moves can get extreme. That's why silver has a reputation for being calm until it's not. It can sleep for months or years, and then it can rip your face off in a short window because the market is not as deep as people think when physical demand spikes. Now let's talk about the industrial side in plain language. The world is electrifying. Whether you agree with every policy or not, the physical reality is that grids are being upgraded, solar installations are growing, electronics demand keeps expanding, and efficiency requirements push manufacturers toward materials that perform well. Silver is one of the best conductors, and it plays a key role in high reliability electrical contacts and certain solar technologies. If energy transition projects continue, if data centers keep growing, if electronics demand keeps scaling, industrial silver demand has a real floor under it. Then add geopolitical uncertainty and currency distrust, and you're stacking two demand drivers on top of each other. Now zoom out again. Russia and China have both signaled interest in a less dollar-centered world, and one of the ideas that keeps appearing in global discussions is commodity-linked trade, settlement and trade arrangements that lean on real goods rather than pure trust in a single reserve currency. I'm not saying anyone is secretly flipping a switch tomorrow and backing a currency with silver. That kind of claim gets thrown around irresponsibly. What I am saying is that when big countries explore commodity settlement, increase precious metals accumulation, and build trade alliances outside the old system, it changes psychology. It tells markets that real stuff matters again. And when real stuff matters, precious metals get attention. Gold usually gets the first wave of attention because it's the classic monetary metal. But silver often gets the second wave. And when silver gets the second wave, the move can be explosive because the market is smaller and more sensitive to flows. Now, if you want to understand why this could shock people, you have to understand how everyday narratives keep them asleep. Most people think if silver was important, everyone would be talking about it. That's the trap. People don't talk about it until after the move. Most people think if there was a shortage, the price would already be higher. Another trap. Shortages can show up first as availability problems and premiums, not just as headline price changes, especially when paper pricing can mask physical tightness for a time. Most people think Russia and China can't really influence a global metal market. That's another misunderstanding. Influence doesn't always mean owning everything. Influence can mean redirecting trade, building bilateral deals, increasing stockpiling, controlling processing capacity, or simply changing incentives so that more metal stays inside a region instead of flowing freely to the global spot market. Even small changes matter when the market is tight. And silver can get tight faster than people expect because it's a metal where sentiment and industrial demand can collide. Now let's lay out a scenario, not a prediction, but a plausible chain reaction. Step 1. Industrial demand remains strong or grows, especially if solar and electrification projects continue. Step 2. Geopolitical tension remains elevated, and the world keeps fragmenting into blocks with different settlement preferences and different supply chain priorities. Step 3. Russia and China, either through direct purchases, policy nudges, or trade incentives, increase precious metals interest and encourage commodity-based stability. Step 4. Investors and savers, seeing higher volatility, inflation risks, or currency uncertainty, increase interest in tangible stores of value. Step 5. Physical silver demand rises, and suddenly the market discovers that the available pool is smaller than the paper volume suggests. Step 6. Premiums rise, delivery times stretch, and the headline price starts chasing physical reality. Step 7. The media finally notices and calls it unexpected, even though the signals were there the whole time. When that kind of chain reaction starts, the move can be sharp because silver is a market that can flip from ignored to crowded quickly. And the reason this could be extra intense is that silver has emotional history. People remember past spikes. People remember the idea that silver is undervalued compared to gold. People remember the stories about paper versus physical. Whether every story is perfectly accurate or not, the psychology exists. And markets run on psychology as much as numbers. If enough people believe the physical market is tightening, they behave in ways that tighten it further. That's how squeezes form. Now, to keep this honest and useful, let's talk risks and counterarguments, because smart thinking isn't hype, it's balance. One counterpoint is global slowdown. If the world enters a strong recession, industrial demand could soften and silver could get dragged down with broader commodities in the short term. Another counterpoint is substitution and thrift. Manufacturers can sometimes reduce silver loadings or redesign components to use less, though performance requirements limit how far that goes. Another is recycling. Higher prices can increase recycling activity over time, adding supply, though it's not instant and not always enough. Another is market structure. Paper markets can remain dominant for long stretches, and price can be influenced by macro conditions, interest rates, and investor flows that don't always match physical tightness in the short run. These are real factors. And that's why the mindset should not be certainty. The mindset should be watch the signals and understand the structure. The signals are things like persistent premium expansion, reports of delivery delays, increased industrial offtake, policy moves around strategic materials, trade agreements that mention commodities, and broader shifts in reserve behavior and settlement preferences. If you study those signals over time, you can tell the difference between a one-week headline and a structural shift. Now let's bring it back to why Russia and China matter in the story. Both countries have reasons to favor tangible assets and commodity leverage in a fragmented world. Both have reasons to reduce reliance on Western-dominated systems. And both have industrial strategies that reward control over inputs. Even if silver isn't the single deciding lever, it can become a pressure point because it touches technology and money at the same time. And that dual identity, industrial plus monetary, is what makes silver capable of shocking people. Because when demand rises, you don't just get a normal commodity move. You can get a move fueled by fear, by belief, by narrative, and by real supply constraints. And if the world keeps moving toward more electrification and more geopolitical fragmentation, silver stays relevant. So what should you do with this? Again, not advice, just a strategic education roadmap. First, stop thinking in memes. Learn the difference between price and availability. Learn how physical premiums work and why they matter. Learn how silver supply is produced and why byproduct dynamics can make supply less responsive. Learn how industrial demand trends influence long-term floors. Second, stop treating geopolitics like a background TV show. Trade alliances, settlement shifts, commodity policies, these things change market structures over time. Third, think in time horizons. Silver can be boring for long periods and then violent in short periods. That means emotional decision-making is punished. Fourth, keep your mind open to multiple outcomes. A squeeze isn't guaranteed. A shock isn't guaranteed. But the setup for volatility can grow quietly until it's obvious. And the worst position to be in is not wrong, it's surprised. That's why I am making this Sunday night alert. Because the people who get crushed in big shifts are the ones who didn't realize the system was changing until they felt it in prices, in shortages, in policy, and in the cost of living. Wealth and power shifts aren't always announced with sirens. Sometimes they show up as small changes in how the world trades and what the world hoards, and silver sits right in the middle of that story. So here's what I want from you. If this gave you a clearer framework, support the channel so more people stop getting blindsided by predictable dynamics. Subscribe and turn notifications on if you want updates when real signals appear. Industrial demand changes, policy shifts, premium behavior, and the macro moves that typically lead to precious metal volatility. Share this with someone who thinks the economy is only about stocks and politics, because the economy is also about metal, energy, and physical constraints. And comment your take. Do you think silver is setting up for the next shock move, or do you think the market stays controlled and calm? Do you think Russia and China's broader strategy of de-dollarization and commodity leverage will accelerate, or do you think it stalls? And what should I cover next? Physical versus paper mechanics, the role of solar demand, the gold to silver narrative, or the way global trade blocks reshape commodity flows? Because Monday comes fast, markets open, contracts move, supply chains adjust, and most people won't notice the game changing until it hits them in their wallets. But now, you're not most people. You've got the framework. Stay curious, stay skeptical, stay informed, and stay strategic, because the world is moving into an era where tangible resources matter more than people want to admit. And silver might be one of the metals that reveals where power is moving next.